Welcome to Yahoo Finance Live. I'm Julie Hyman. That's Josh Lipton. We're here at the New York Stock Exchange bringing you what you need to know at 3 p.m. Eastern. Stocks under pressure, and with the declines today, the S&P 500 now joins the NASDAQ in correction territory. Remember, that's a decline of 10% from its most recent high, and it does follow the NASDAQ entering into a correction earlier this week. But for today, tech stocks are bucking the downward trend thanks to Amazon and Intel.
And shares of JP Morgan Chase trading lower today. It's on news. CEO Jamie Dimon plans to sell 1 million of his current shares. The sale prompting speculation about whether Dimon could be retiring from the bank, especially since it's the first time he's ever sold shares. But a spokesperson says that is not the case. We're going to take a closer look and also look at CEO turnover at some other companies, including JP Morgan's rival, Morgan Stanley.
And finally, the Fed's preferred inflation gauge showing further signs the prices are cooling. PCE grew 3.4% year over year in September. That was in line with estimates. And core PCE, excluding food and energy, posting its biggest monthly gain in 4 months. That was driven by spending on things like cars, travel, and prescription drugs. All of this coming ahead of the Fed decision next week. We'll look at what the numbers today mean for the path of Federal Reserve rate hikes. Let's get you up to speed on the market action right now, though, as we are seeing some pressure for stocks, at least some of them. The Dow today is the underperformer, sort of flipping the script from what we have been seeing for most of the week. It is down, the Dow, that is, by about 427 points. That's a drop of 1.3%. The S&P down as well, 0.7%, but the NASDAQ is bucking that downtrend. It's gaining about 1/5%. It's consumer discretionary and tech that is helping buck the downtrend today. Energy, healthcare, financials, utilities, real estate, all pretty deeply in the red.
And has been a jam-packed week for investors, from the 10-year U.S. Treasury yield hitting 5% to the mixed bag of big tech earnings. Markets attempting to regain their footing here as the NASDAQ entered a correction this week. So we are sliding here with the SPX, the S&P 500, extending this slump since the peak, Julie, we hit back over the summer in July. So we're now in our third month of declines here. Even as we did get earnings this week, I mean, the mixed bag is right. I mean, certainly some disappointing, like Alphabet reported cloud numbers, not good, not what the street wanted to see. You saw investors get spooked by that. On the other hand, we saw others report, and they pleased investors. You know, Amazon report rallied, profit tripling to nearly $10 billion. Intel, the outlook beat expectations, maybe a PC recovery taking hold there. But we do have continued worries as well here, and that's weighing on the market. So soaring yields, war in the Middle East. It's interesting to see gold, for example, catching a bid here, perhaps again, not surprising given the headlines we're seeing out in the Middle East today. And the pain is broad, by the way, in the market. Bloomberg noting here that more than 2/3 of stocks for the companies in the S&P 500 are now trading below their 200-day moving average, so a long-term trend line that traders watch closely.
Yeah, I'm taking a look at the Wi-Fi Interactive at some of the other metrics here. When you talk about broad-based declines, it also goes for the sectors. Utilities was the only group that was in the green on the week, as perhaps investors were looking for a little bit of defense here. Energy, communication services, and healthcare are those dark red that you see at the bottom right of your screen there. And then when you look at the NASDAQ 100 components, to your point about some of the pain that we are feeling in some of these Magnificent Seven stocks, right? Yes, Microsoft and Amazon held up well in the wake of their earnings, but look at the decline for Alphabet, off by 10% on the week. Meta down 4.4%, Tesla and Nvidia as well, and Apple. So even the companies that haven't reported, right, are under some pretty steep pressure here. There is one maybe silver lining, and that comes from the so-called seasonals, right? That we're pretty much around seasonally and traditionally where markets tend to bottom for the year. This is something our friend of the show, Ryan Dietrich, tweeted about today. He said the bottom for the markets usually comes around my birthday, which he said is October 28th, but the markets are closed on his birthday. Separately, Jim Reed over at Deutsche Bank putting out a similar chart where he basically looked at the average daily performance of over the course of the year to illustrate kind of seasonally how this looks. And you can see here the average daily performance, if I had a pointer I could circle on the chart here, but you see on the October area there where you tend to see that near-term bottom or a lot of selling happen and then a lift through the end of the year. That doesn't mean it's going to happen this year, but it does happen on average.
And you did also mention Apple, which is worth noting. So in the red, and they, of course, report next week. And you can imagine a lot of focus and attention, of course, on that print, because that, of course, could move the market either way. Still up about 30% year to date heading into that print.
Yes, it could move the market either way, but like people were looking for Alphabet and Microsoft, right, and Amazon to save the market this week, and it hasn't
Not yet.
really worked out that way, at least to your point, not yet. We also have economic data that we got to talk about, right? The Fed's preferred inflation metric showing prices continuing to ease in September. Year-over-year core PCE coming in at 3.7%. That's the smallest gain year-over-year since 2021. It comes after the U.S. economy grew at its fastest pace in nearly 2 years. As the Federal Reserve gears up for its next meeting, we're taking a look at what this all means for future rate policy. And joining us now, T. Rowe Price, Chief U.S. Economist, Lorena Urici. Thanks so much for being here, because even the signals today, even the PCE today, Lorena, I could argue you could look at it in a number of different ways in terms of your slicing and dicing, because month over month we saw reacceleration, but year over year the numbers looked better. What's your takeaway for what this is going to mean for the Fed?
Thank you for having me today. And we have a complex economics picture here. A few unexpected things have happened during this business cycle. We're having progress on inflation, moving down from the peak of 2022. At the same time, the unemployment rate is at historical lows and consumer spending remains strong. So I think as we go forward, a couple of things that are going to be the focus for the Fed. I think they're going to maintain a hawkish bias because the economy is so resilient and the progress that we've had on inflation has not really spread over to services inflation that is more tightly linked to the labor market. So that's one part of it. But the way that this hawkishness is going to express itself, now that interest rates are at about 5.5%, is through pushing back against market pricing of cuts in 2024. So currently the market is pricing that cuts from the Fed will start in the middle of next year. I think this is too soon, and Fed communication will probably push back against that. But more importantly, as the economy remains resilient, I think market probabilities for next year will push those cuts further back too. But there is also an aspect that we need to discuss and recognize is the fact that the long end of the yield curve has increased a lot. Yields are up significantly since the last Fed meeting in September. And so I think what this means for the Fed is that perhaps they don't need to deliver as many hikes, for this year as they had promised at the September meeting.
And Lorena, when you look at that labor market right now and how it's sturdy, so sub 4% unemployment, wages rising, can the Fed get inflation back to its target, back to 2% with a labor market that is that sturdy?
So this is the key question for the Fed. So just quickly, when I characterize the labor market with our PMs in our discussions, what I see is a cooling in the labor market through slower employment growth and higher vacancies, but not a rolling over. So then the question is, can we bring inflation down to 2% without a meaningful increase in the unemployment rate and more significant layoffs in the economy? Historically, the U.S. economy has not been able to do this. What could be different this time around is that we're seeing an improvement in labor supply. The labor force participation is increasing, and this could be bringing downward pressure on wages. In fact, quits rates are not as elevated as they had been for the last 2 years. They're now back to pre-pandemic levels. And the key will be perhaps that the Fed learns the lessons of the past. It proceeds cautiously now, but it does not cut interest rates prematurely. So then if you keep the pressure on inflation and the economy throughout 2024, we might have a chance of avoiding a deep recession while also bringing inflation down.
It seems like it's still going to be a tough needle to thread potentially. And I'm fascinated by a chart that we got from Apollo's Torsten Slok today, where he basically posits that the market always gets wrong when the Fed is going to raise or cut. That it's sort of always overestimates how soon these things are going to happen as priced in by Fed funds futures. And so this time around, how do we sort of, and there's a chart showing that basically Fed funds futures in blue, all the times that the expectations were so wildly different than from what actually happened. So what does that then tell us about how cautious the Fed might be and the implications for the economy?
So when I look at that chart, the first impression that I have is that forecasting is really difficult. Be that
Yes.
economist or market pricing. We get it wrong all the time. And so let's be humble about it and let's admit, where do we have more visibility? Right now, we look at economic data. The US consumer is very resilient. Their balance sheets are strong. Employment growth is solid. So that means to me, no imminent recession risks. So at least I have more confidence 6 months out that the US economy is not going to slide into a recession. And so that should translate into a Fed that does not cut interest rates as fast as the market is expected right now, because there's not going to be the need to.
And Blarina, last question here on the consumer. A couple different data points. I want to bounce them off you and see what you make of it, because we got consumer spending numbers today too, and this rose 0.7% in September. I think it was 0.4% when inflation adjusted. So that would signal we do keep spending here, our friends and our neighbors. There was also, though, Blarina, it was interesting, Amazon's CFO on their earnings call, he said from a customer behavior standpoint, we still see customers remaining cautious about price, trading down where they can, and seeking out deals, coupled with lower spending on discretionary items. I thought those were just interesting data points. Bottom line, Blarina, when you look at the consumer right now, how strong and healthy are they right now, and what do you see ahead?
So I think the US consumer, being 70% of the US economy, is really the key to sustained growth and a sustained recovery. And ultimately, what matters for the US consumer is the labor market and whether we're seeing continued increases in employment. So employment growth is strong, and that helps to deliver solid aggregate income growth. And that's what's supporting consumption right now. The other thing is inflation is coming down. So real disposable income has also improved in recent months. That's another positive for the consumer. And then if you wanted to take a longer structural view of the consumer, you'd look at their balance sheets. Asset as a share of liabilities are at historic highs. Debt servicing costs are relatively low, even though interest rates have increased so much, because a lot of the household debt is locked in at lower interest rates. And so this business cycle, we don't have the kind of deleveraging that the consumer was doing post GFC. They have more firing power. Also, they have more ability to leverage to fund consumption. And I think this is what is prolonging the life of this recovery, even though interest rates have been increasing so fast. I think this is where people are maybe going wrong when they expect the US consumer to roll over quickly.
Blarina Urucci, thank you so much for joining us today. Now let's take a look at some of today's trending tickers, and the three big automakers are sliding today. It's on the back of weak results from Ford. Ford revealing it's putting the brakes on $12 billion in EV spending as demand weakens. The news coming on the heels of a labor deal it reached with the UAW. General Motors may be next to make a deal. The two sides are back at the negotiating table after a marathon session overnight. So Ford is getting hit today pretty hard, Julie. So reported and missed, pulled the forecast. As we know, what they did say about EVs, I did think that made headlines, and that was pretty interesting. They pushed out $12 billion in EV-related investments, so questions now about their shift to EVs, electric vehicles, of course, all against the backdrop of this tentative deal with the UAW.
Yeah, and even, before they made this deal with the UAW, it cost them quite a lot of money. The company saying that they were pulling their forecast as a result of this, but it cost the company $100 million in the third quarter and a total of $1.3 billion so far. So that's the tally here from the strike. It still has to be ratified, the deal between Ford and the UAW, but there's every indication that it will indeed be ratified. But then costs are going to go up for the company, and we should get a new estimate for what that's going to look like. So that's on the one hand. And then on the other hand, you have their Model E division now, which is their electric vehicle division. They're delaying that battery plant, and the losses in that division were bigger than estimated. So there are now a lot of questions for this company and really for all of the companies that are making these things.
Lots of questions. You can see that reflected in today's price.
Exactly. Let's talk about pharmaceuticals, too, and talk about Sanofi. Those shares are plunging, U.S. shares of the French drug maker, after it reported disappointing earnings. The company losing more than $20 billion in market value as a result of this. Sanofi dropped its profit target for 2025 as part of a plan to spin out its consumer health business. It also expects earnings to decline next year from levels this year due to R&D spending and a change in its tax rate. Now, this is really an industry-wide change that we have seen here. So you now have Johnson & Johnson, Pfizer, and GlaxoSmithKline that have all spun out their consumer health businesses. And now Sanofi is joining that list. Bayer, the German drug maker, is the only one left that hasn't done this. So that's the big announcement here. But at the same time, it really seems to be the warning that is weighing on the shares here. All of these companies sort of concentrating on higher profit, moonshots, if you will, although in many cases moonshot makes it sound less sure than it is. But, you know, these sort of more experimental drugs that can be big, big money makers for them.
Yeah, it was a surprise by the drug maker, not a good way. The forecast for lower profit next year. You know, analysts are weighing in here. I know the team at Morgan Stanley was saying the EPS forecast suggests expectations will be lowered by about 9%, right? They say plans to spin off the consumer healthcare unit you were talking about. That is positive. So they see some good, some bad. No surprise. They're on the sidelines with an equal weight.
Right, but it tells you how bad the perception of the bad is.
Yeah.
That the stock is down 19%, even with what's viewed as the more positive news, the consumer health business spinoff. Yeah.
Not news that investors wanted to hear.
Yeah.
All right, let's turn to our final one here. It's a different story for Juniper. The stock bouncing on Q3 earnings, reporting after close last night. The IT cloud company beating on both the top and bottom lines. Analysts saying enterprise and corporate sales were the bright spot here. So big jump here. That's a nice 7% pop. This is a communications equipment maker, post better than expected revenue and adjusted EPS. Strength, as we know, being called out in the enterprise segment specifically. Some bulls like Evercore like what they saw, Julie. They have a target now of 30, it looks like. Secular tailwinds, they called out. Share gains. They expect enterprise business to sustain growth in 24. Others, we should note, not as sure. Piper, for example, is at a neutral. They say, frankly, the bar was low here, and in their opinion, Q4 guidance was largely in line. But listen, investors like it. Big pop.
If you look at the different sectors here within the company, it did see declines in some of its business lines, including in its cloud revenue division and also in its service provider revenue. And both of those numbers missed estimates sort of within the broader third quarter report. Nonetheless, as you said, there does seem to be some optimism here. And as we look at the now collection of companies, handful of companies that serve enterprises that have reported their numbers within tech, it seems like it's been okay.
Yeah.
Right? You know, that you're not seeing that much pessimism reflected there, which I think is kind of interesting. And I guess Juniper, the latest example of that.
We should know it's a nice pop today, still down about 16% year to date.
That is a good caveat. We're just getting started here on Yahoo Finance Live. Coming up, oil prices are surging, solar stocks are plunging. We're going to break down where we are in the transition to renewable energy. And the last day of spooky stocks. We're going to break down why we've seen such volatility in shares of COVID vaccine maker Moderna. Also, Ozempic frenzy. We'll talk about the hype around different weight loss drugs and explain why the hype might not be justified. Imagine that. All that and more when Yahoo Finance returns.
2023 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation,
Mortgage rates,
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it November 7th, exclusively on Yahoo Finance.
Well, the S&P 500 is set to enter a correction today, down 10% from its recent high. Jared Blickery's on the floor of the New York Stock Exchange, looking at some of the individual stocks hitting 52-week lows. Jared, I know you've also been watching what the level is, 4130.06 for the S&P to enter correction.
You have a great memory, or you're reading that. I just put that in, didn't have it offhand myself.
latter.
But unless there's a miracle or something, we are going to enter correction territory. More disturbingly, this has been a week about breakdowns, and this is not some trifling thing like a false breakdown where you expect the market to pop next week. This is serious stuff. Let's go to the Wi-Fi Interactive. First thing I want to point out is that the NASDAQ is positive today. Market difference from the Dow, for instance, but that's thanks to the earnings that we had from Amazon, Intel, and then Meta's joining the fray. The mega cap's doing well today. You can see 2.81%. That's what it is down for the week. However, and you mentioned those new 52-week lows that we're looking at. That is occurring in a broad swath of sectors. This is just a sampling. You can see Johnson & Johnson down 2%, Home Depot, Chevron. You thought energy was a bastion of safety? Well, check again. Chevron just dropping to new lows. This is a one-year chart right now for the year. And in fact, you take a look at a three-year chart, holding on to gains, but still, you got to think that there's more at work here. Here's Ford Motors, again, 3 years, but you take a look at the 1 year, just broke down because of its earnings. I think this earnings season is showing that a lot of these stocks that were just kind of holding on by a thin razor's edge to some support levels, boom, they're breaking it. Let me show you what's happening in the sector action. Julie, I like how you kind of opened with this. I'm just going to go over this one more time. Utilities up 1%. Also, staples is less bad than some of the others, real estate as well. But energy, communication services, healthcare, all of those are underperforming. So it doesn't look like there's any bastion of safety here that we can count on. And then you take a look at the NASDAQ, that's actually looking pretty good today, but this is for the week, and you can see some huge, huge drops like in Alphabet, for instance. So all in all, Julie, I'm looking to next week. We could see a bounce. I'm with Ryan Dietrich there. Seasonality favors the bulls. However, everybody I've been talking to, they're going to be selling the rips.
Jared Blickery, thank you. And the selling accelerating now as we head into the close here. The Dow now off more than 400 points, and the S&P 500 is in correction territory. Earnings have been driving the action all week, but we're taking a closer look at the charts and what the technicals are saying about the market. Joining us now is Jeff Bierman, Theo Trade Chief Market Strategist. So, Jeff, let me just start with the S&P 500. When you look at the SPX, what are the charts telling you, Jeff?
Well, Josh, I don't want to be the add insult to injury and be the bearer of bad news, but we are now officially at the crossroads of the official dreaded death cross. So a lot of professional money managers have their eye on the 50-day simple moving average against the 200-day simple moving average, and the crossover just tagged today. Now, it's not a leading indicator. It is a lagging indicator. Nevertheless, once these death crosses where the shorter period crosses below the longer period, it tends to be a setup for anywhere from 3 to 6 months for a lower market. So from that perspective, we ought to be cautious. From a second perspective, the advanced decline line has been on a very rapid deterioration, but it has been holding above its 252-day moving average for the better part of about 16 months. Well, guess what? It actually broke down on Monday, and it's accelerating to the downside below that 252-day moving average, Josh. And that's another form of a death cross, but not by price measurement, but by advanced decline or breadth measurement. So the setup just does not look good right now.
On the flip side here, how much do you sort of factor in seasonals, right, when you are also looking at the technicals? Because as we talked about at the top of the show, seasonally, we're going into a pretty good time of year for stocks, right? And coming out of a seasonally weak time of year for stocks. So how do you cross-reference that with the death cross?
Love that question, because at this point, markets tend to bottom by script 4 out of every 5 years in October, and you're starting to feel the pain. You're starting to see gold explode higher out of fear. And that's a good setup for what could be a really good counter trend rally into the year end. So seasonally, I would start to look for the market to kind of like capitulate within the next week or so and start a November rally. But I think the rally itself is going to be short-lived. I know you've heard the expression location, location, location. Well, for me, it's interest rates, interest rates, interest rates. I've done interviews all year long in different social media venues, and I kept saying it's the year of recalibration. You're not going to escape interest rates because it's a kryptonite that forces all the recalibration of valuation metrics, especially on growth stocks. So even if we are to sustain a rally, which I do think is going to happen upwards of 3 to 4 to 5% over the next month, I don't think it's going to last long simply because the economy is slowing down a lot faster than people expect.
And Jeff, let's talk about some sectors where you're relatively more bullish. It looks like you do like some defensive areas like utilities and healthcare.
Actually, I really do for this reason. We're hurtling into a recession. Now, whether we get a hard or soft landing, Josh, I can't make that call. Nobody knows until we actually get there. But one thing I've learned over the years, 35 years, is when you go into a recession, growth stocks, they die a fast death. And the sector rotation necessitates that you go for what I call, dividend yield, protection, low valuation, defensive plays. And I'm seeing some of the cheapest valuations I've seen in decades on certain stocks like Baxter, AT&T for defensive, Verizon. As a matter of fact, both those stocks reported this week beat their estimate, guided higher, but more important, they blessed their cash flow. And if the cash flow itself is in good shape and it's protected, that tends to be a good place to hide as like an alternative or a proxy to, let's say, a CD or a bond. So if you're afraid about interest rates going that much higher, the utilities have already been priced to death on it already. So I would be shifting towards more defensive plays like some pharma and AT&T and Verizon. That's where I'm placing my money with 8-9% yields.
It's interesting here. You're also talking, you mentioned utilities, right? As a group also that has relatively high yields here. I'm also curious how you're thinking about, excuse me, these high dividend plays versus fixed income, for example, or actual CDs or money market funds, right? Yes, you might get some more yield from some of these companies, but you could also just buy the various other instruments.
Well, as a matter of fact, I do own a lot of CDs right now, paying me 5.5%. But I want to put a tag on this. You have no upside to a CD, zero. The one good thing about owning stocks is when you buy them with high yields, the yields will go down, but the stocks will eventually go up. So the upside, to me, the risk reward pays off to buy these to get even a 5 or a 10% bump in the stock price and lock in a 6%, 5% yield. You can earn 15% over the year if you can sustain and the dividend is secure against just getting a CD that pays 5% with no upside. So to me, I think you should start to explore a split between, let's say, CDs. I'm not sure on bonds yet. I'm not sure we hit a bottom on bonds, but we're getting pretty close. I don't think the Fed wants us above 5 3/4, but just because we're down, in bond hell doesn't mean that we can just pop out of there. We might sit here for a while just on what I call a volatility reset, because the data came out today. It was really a 4.9% GDP. That's not what the Fed wants. That's inflationary. And then you come out today and say consumer spending 0.7% up. That's not what the Fed wants. The Fed wants things to cool down. So you could have inflation be sticky here for a lot longer than you think.
And Jeff, we talked here about technicals, we talked seasonality. What about valuation as well, Jeff? I'm interested to get your perspective there with the market getting banged up like this. How does valuation look to you?
It's getting better, Josh, but it's not there. Listen, the valuations, go hand in hand to a degree with interest rates. So for instance, over the last 27 years, the high print on the 30-year Treasury yield was 7.11%. Over the last 20 years, the high print on the Treasury yield was 5.3%, and that was back in 2007. Right now, we're around 5, and we tagged about 5.1. The last time we were at a 4 or 5 handle, we were at 3,600 on the S&P. If you go back on the S&P, the last time we were at a 5 handle, we were somewhere around 3,400 on the S&P. So it's not entirely out of the question, don't put this down and say it's impossible, that if interest rates continue to maintain their level between 4 and 5%, we could reprice down to 3,500 to 3,300 in the S&P just alone off tech stocks, off cyclical stocks, and off of some retail stocks, which are still sporting PEs above a 20 multiple. So when I say recalibration, I'm saying some stocks have already bottomed, but some can continue to regress to the mean and continue to go lower until they're single digits. So my bottom of the market valuation, Josh, about 32.75. It may not get there in an hour or tomorrow, but eventually I think the market's going to give way to the fact that you cannot escape the interest rate kryptonite like pull. It's impossible.
32.75. That's a lot lower than we are right now, Jeff. So buckle up, I guess. Thank you so much for your perspective. Have a great weekend. Appreciate it.
You too. Thank you. Take care.
Thanks. Coming up, Intel shares jumping on earnings. We'll bring you a conversation with the company's CEO coming up after the break.
Intel out with better than expected results and signs potentially of a big comeback. Joining us now is Intel CEO Pat Gelsinger. Pat, well, there are a lot of doubters out there. What do you say to them today?
Well, hey, this was just a really good quarter financially, but even better quarter operationally. And I've just said outstanding performance and, a clean beat on the top and bottom line, a raise of guidance, great operational performance in our cost saving initiative. But even more significant, Brian, was the major milestones that we hit operationally, key roadmap milestones and PC, the AI PC, the server progress, our AI product lines. But maybe most importantly, the process technology, our 5 nodes in 4 years, just hitting major milestones on that audacious plan that we laid out. But also the first foundry customers, and I promised you one. We now have 3, the first major advanced packaging customers coming into our foundry. So really across the board, an outstanding quarter for Team Intel. And yes, Intel is roaring back to life.
Pat, I've had the pleasure of talking to you after, I believe, each quarter of the past, let's say, 5 quarters. This quarter, I think, was the first quarter where there were real signs of tangible improvement on cost savings, on product execution. How is the company different today compared to 6 months ago?
Well, in a lot of ways, hey, if you were inside of the company 2-3 quarters ago, Brian, you'd say, I'm starting to feel it. And a lot of those things you see internally before they're visible externally. And we've been just one by one building more momentum. Our cost savings initiatives have been gaining more momentum. This internal foundry model gaining more momentum. And a lot of the product executions, well, we knew they were going to look better, a quarter or two ago, but now they're visible externally as well. So I just say, hey, the momentum is building. And we still have a lot of work to do. As I said when I took the job, it was a 5-year effort to rebuild this iconic company. And here we are halfway through, and now the visible, tangible proof points of that are seen in our customers, in our products, in our financial results. A really outstanding quarter.
One thing that stood out to me on the earnings call, Pat, there was a lot of name drops on new products. For the average investor out there that doesn't have your technical expertise, what are the 1 or 2 products that are going to change the game for Intel over the next 18 months?
Well, on the client side, I just call it the AI PC. And we have the next 3 generations. One is ramping today, our Core Ultra, but then the next 2 products that come in 24 and 25 already well underway. On the server side, we say our Xeon product line, we delivered our Gen 4 is ramping ahead of schedule. Gen 5 is already in the market, and we're going to be announcing that in December. But next year's products and our 25 products are already hitting key validation milestones. And maybe the final one is the AI product lines and our Gaudi products. We're now racing to catch up to demand, and we're winning benchmarks with those and really participating in that surge of AI interest that we're seeing across the board. So all of those areas gaining momentum, a really great quarter.
What exactly is an AI PC? You're not the first person in tech that has called that out to me. What does that exactly entail, and how does that change your business?
Yeah, and an AI PC is now one that you're not going to the cloud to use these AI capabilities. They're right there in your PC, your local data running on your PC in real time. And imagine that you and I, the next time we have a conversation, right before the conversation comes up, it says, this is a summary of your last interview with Sazi. This is what you guys talked about. And remember, this update on his family is coming up. And that just appears as part of our next conversation that we might have on Zoom or Teams, recording everything that you do, getting this contextual information. Wow, that improves my productivity. Or imagine that you're a visual arts creator and you're able to take advantage of these generative AI models being done locally, and you're able to be far more productive. Or a legal brief, right, is being appeared in real time if you're an attorney or a sales leader. All of those being done on your local PC, and the productivity improvements that result from that, we think are going to be quite outstanding across numerous, blue and white collar kind of assignments. So we're quite excited about it, and I've called it a Centrino-like moment. Centrino really ushered Wi-Fi and wireless connectivity in. We see the AI PC ushering in a new phase of PC use cases and really being an accelerant to the overall PC category.
Pat, I don't see any of this stuff in my local Best Buy right now. When do these PCs start to hit the market?
Well, we're starting to demonstrate these capabilities. We announced 100 ISVs as part of our AI acceleration program, and our first generation of that, our Core Ultra, we're going to formally launch that December 14th. So somewhere there in New York, we're going to walk down to a store together, and I'm going to say, here, this is your first AI PC, Sazi, and we're going to show you some pretty cool applications that are running on it on December 14th.
Hey, sign me up for that, sir. I'm definitely down for that. In the data center now, when can you say we are grabbing market share again in the data center?
Yeah, I think we start to see that in 24. We knew that we had some losses of key designs that, began in 22. So some of the current situation is as expected, but we did perform a bit better than we thought we would this quarter. Sapphire Rapids, our Gen 4, is ramping ahead of schedule. The next generation, Gen 5, it's already in market and starting to ramp. But next year's products really increase our competitiveness substantially, and we believe they're strong enough that we can start to gain back market share. And I'm already sending my 25 products into fab, and some of those will begin in Q1 of next year. So we're well on track to even have better products coming in 25. So I think 24 is the time when we start gaining back share and really complementing that with our AI products like Gaudi. Intel is back in the data center, winning share, better products, better execution, and our customers are starting to see us and give us credit for that.
Since the last time we spoke, Pat, there's been just new concern on the relationship with China in terms of chips, what we may be able to ship there, what they may be able to ship here. From an AI perspective, how much of a risk is China?
And overall, what's you've seen out come from the government, from the BIS regulations, have been their efforts to limit these high-end training capabilities going to China, and something that the U.S. government wants to keep that as an area of competitive advantage. And we and others in the industry, need to comply with those requirements. That said, the bulk of our shipments to China are around, use of our products like Xeon and PCs. That's where our business is substantial. And, we'll work closely in understanding those regulations and understanding our, business implications thereof, and making sure we both comply as well as maximizing the market opportunity that we have. Because we've been in China forever, we have great customers there, and we're going to continue to support those customers.
I think a lot of investors don't realize, Pat, that Intel has had close to 50-year history in Israel. You really talked about that on the earnings call. Mm-hmm. What is your assessment of the situation, and how does Intel play in Israel moving forward?
Yeah, next year will be year 50 for Intel in Israel. And this is part of the Intel team in so many ways. We're one of the first companies to really take advantage of what's become known as the startup nation in Israel. That said, we have, focus on making sure our teams are safe, their families are safe. But the thing that is so amazing, Sazi, is that this is a resilient people. And our operations continue, our fabs, and the construction of our next fab is continuing despite all of these challenges that they're facing. And our thoughts and our prayers are for a quick resolution and peace to be restored in that area of the world. These are not just colleagues, these are friends of mine personally, and I'm just heartfelt for that situation.
All right, well said, and we will leave it there on that note. Intel CEO Pat Gelsinger, good to see that turnaround taking shape. We'll talk to you soon.
Thank you, Sazi.
Just days before Halloween, we are looking at stocks that have spooked investors of late. We're wrapping up the week with pharmaceutical and biotech company Moderna. Yahoo Finance's Anjali Kemlani has the story. Anjali.
That's right. The specter of pandemic profits is causing jitters among investors and their outlooks for companies like Moderna, whose outsized windfall from the pandemic has investors thirsting for more. Moderna is known to most as a company that makes one of a few COVID-19 vaccines. But what you may not know is that the vaccine is Moderna's single most commercially available product, which makes the stock extremely susceptible when demand for that slips. Moderna peaked at nearly $450 per share in late 2021, and by comparison, it's been exsanguinated to about $75 per share today, near late 2020 levels, but not enough to be buried underground. BioNTech, which partnered with Pfizer to produce its COVID-19 vaccine, has been on a similar trajectory. But Pfizer itself hasn't necessarily enjoyed the same volatility since and during the pandemic. Ironically, the spirit of Pfizer stock is the only one possessing Moderna and Pfizer's partner BioNTech, as seen in recent weeks. When Pfizer lowered its guidance to decrease vaccine sales, it was Moderna stock that took a hit. And it's now nearly $25% down in the past month alone. So will Moderna's ghost haunt us only in the pandemic memory, or will it come back to life with a new product, validating the hype around mRNA? Moderna recently shared ambitions to launch 15 products across oncology, respiratory, rare, and latent diseases by 2028. And do investors need to see the approved products to believe it? That's the question that remains to be answered. And that being said, there is some optimism among analysts. Moderna does currently have 12 buy ratings, 10 holds, and 2 sells.
Anjali Kemlani, some excellent spooky wordplay there to talk about a very interesting stock to round out our spooky stock series. Thank you so much. Appreciate it. Well, for more on Moderna and the stock's volatility we've seen recently, we turn to Ted Tentoff. He's managing director and senior biotech analyst at Piper Sandler. And as we've been talking about, Ted, this is a single product company for now. Do you have confidence that it's going to get some of its other experimental products approved, and then we'll be able to compete with some of the others that are in the pipeline for competing drug makers?
Yeah, that's a great question. So when you look at it, I think probably the biggest thing about the pandemic for Moderna is that it not only enriched the company's balance sheet so that they've been able to increase their R&D investment, but it's fundamentally de-risked mRNA technology for vaccines. So as you pointed out, Moderna will still generate somewhere around $6 billion in COVID vaccines this year, but they're also preparing to launch their second vaccine for RSV, or respiratory syncytial virus, in the second quarter of next year. And also they've developed a seasonal flu vaccine, which could also be launched next year. So we'll see the burden, the share, the revenue share, start to be augmented by these new vaccines, and the company not simply relying on COVID vaccination rates.
But that, Ted, before we get into their pipeline, that updated COVID-19 shot they introduced in September, what do you think the financial impact is going to be there for the company? What do you expect demand to be like there?
Yeah, so again, they originally guided $6 to $8 billion this year, really contingent on somewhere around $2 billion of U.S. vaccination revenues. We're clearly seeing that vaccination rates are low. So it could be, our current guidance is, they've recently said, within the low end of that 6 to 8 range. That's still positive. Bringing in $6 billion a year for a company that before the pandemic was bringing in, a couple $100 million. This is still a meaningful product for Moderna and will be an important vaccine for the company and for really the world, especially if we face heightened or worse COVID seasons. it's going to be kind of like the flu vaccine, where especially people who are at risk, whether they're immunocompromised or elderly, still should be getting their COVID vaccine. So we really do project that out at a couple billion, probably below this year's guidance for the next several years.
And Ted, sort of more broadly as well, when you look at the attention on respiratory diseases that came as a result of the pandemic, of course, Moderna was only one of the companies that was trying to address that. So when you look at the attempt to treat respiratory diseases like COVID, like RSV, let's throw the flu in there as well, how do you view the space there and sort of that competitive landscape?
Yeah, well, these are really important products. So RSV, for example, really impacts the elderly, typically people in their 70 plus years of age. Obviously, flu is still a huge burden, and as many as 25 to 30,000 people die every year from flu. There's also other vaccines that could be, like, for example, RSV impacts younger kids too, and is actually one of the primary reasons for young children to go to the doctors, and even 200-some thousand hospitalizations a year, and can cause wheezing. So these are very important vaccines. I think one of the interesting things that Moderna is doing is starting to combine these vaccines. One of the really exciting things about mRNA is you can fit a lot of different antigens within a single vaccine. So for example, they can have your 1 or 2 COVID antigens plus the 4 or more flu vaccines. So actually in 2025, rather than getting a COVID vaccine and a flu vaccine, you'll be able to get a single shot. And I really do think that moves the ball forward in terms of improving compliance and vaccination rates, especially again in these at-risk populations like the elderly.
And Ted, I want to get you out of here on this. The stock has been obviously crushed. It's down 60% this year. What are some potential catalysts, Ted, that investors should have on their calendar with this name? I think, Ted, they're reporting earnings next week, I believe. What are you expecting there? And could that be a possible catalyst?
Yeah. So again, next week we'll get third quarter earnings on Thursday morning. The third quarter is actually a portion of this full guidance of 6 to 8 billion. We probably will get some update for 2023 COVID vaccine revenue guidance on that. Again, the vaccination rates are low, so I'm not going to speculate, but it'll be at the lower end of that range, maybe even below that range. We'll see where it comes in. But then I think we're really going to start to see, especially going into next year, with the RSV approval in the second quarter, and then the flu vaccine approval next year, probably middle of the year, later next year, we'll actually see a stronger, or maybe a resumption of revenue growth in the back half of 2024. We'll also get updates from other products in the pipeline. So for example, they're developing a vaccine for cytomegalovirus in phase 3. And this is actually a infection that still, when it infects a woman in her 3rd trimester of pregnancy, is one of the leading causes of birth defects in children in the developed world. So in America and Europe and Japan. So that's another important vaccine that'll be coming. Also, Moderna's working with Merck to combine Keytruda, their blockbuster, with a personal cancer vaccine, or what they're now calling an individualized neoantigen therapy. It basically educates the immune system against the cancer, against the tumor cells, and really works synergistically with Keytruda. So we're going to be getting updates on those programs, as well as a bunch of earlier stage programs, really over the next, into 2024 and beyond.
Ted Tenthoff, thank you so much for joining us today, Ted. That was really helpful.
Have a great weekend.
You too. All right, coming up, closing bell on Wall Street. That means we're checking in on the latest market moves and the top trending tickers. Stay tuned.
And there you have the closing bell on Wall Street on this Friday here. It looks like we still have a mixed picture here as we close things out, but it has been a negative week here for the major averages, even with the NASDAQ eking out a gain of 0.4% here to close things out. The S&P up 0.5%. The Dow down 366 points. That's a drop of 1.1%. And if you take a look at the Wi-Fi Interactive, just looking at the totals for the week here, the S&P 500 finishing down by 2.5%. That is its worst week going to September 30th, and it looks like its lowest close going back to May as well. If we take a look at the Dow for the week, we've got a drop of 2.1%. And if we can look at the NASDAQ, but we're getting a little buggy here. We'll skip the NASDAQ for the moment, but switching on over to the NASDAQ 100 here, a little bit more green on the screen for the NASDAQ, especially lifted by, of course, the likes of Amazon after that company's report after close yesterday, and a forecast that really reassured investors. The shares up some 7% on the day here. Meta, Tesla, Apple, Microsoft also bouncing back on the day. But as we talked about earlier, the week not looking as positive here for these large cap stocks. Just switching back over real quick here and taking a look at some of the trending tickers that we saw in the session, because a lot of big companies out with their earnings. We talked about Ford earlier, and its 12% drop on the day, 14% on the week. Intel shares up some 9% on the day here after that company's earnings report. And JP Morgan Chase on the news that Jamie Dimon, the CEO, would be selling some shares, although it doesn't seem to bode anything bigger, right? Still seeing the shares down 3.6% on the session. Let's take a look at some other trending tickers here as well. U.S. Steel is one of them. The company projecting profits for 2024. The CEO noting serious interest from many highly credible bidders. Remember, this coming as U.S. Steel beat on the top and bottom line in its latest quarter results. But the bidders part is because there has been interest from other parties to buy U.S. Steel, including from Cleveland-Cliffs, but there's no concrete news on it happening as of yet.
Oh, you wanted details. Is that what you were looking for? Some specifics?
Yeah, multiple credible bidders. I don't know, but maybe some analysts or some investors want a little more concrete news than that.
It does, yeah, so it doesn't we don't have the names, it sounds like, of the bidders, and I don't think we have a deadline here of when we might hear some news. But this has been in the mix for a while now. I mean, this is obviously, it's a storied company, still a major steel producer, big manufacturer of automotive steel. And it will be interesting to watch what happens depending on the news, how big a combination is. Do regulators take a look? Because as we now know, big corporate combinations now, Julie, do tend to get a bit more scrutiny. So it'll be interesting to see how this one plays out.
Yeah, it definitely will here.
All right. You got Charter Communications. Let's hit that one. Shares sliding in today's trade. That's despite reporting a beat on earnings. The company delivering soft broadband gains in the quarter and raising its CapEx forecast amid tough competition in the market. So this one, Julie, was interesting. They beat earnings estimates. Revenue came in a bit light, I think, relative to expectations. One metric making headlines, they lost about 100,000 cable subscribers, and that was from that fight with Disney, which we all remember. Customers were unable to watch ESPN there and other channels for about 10 days this summer. In total, they lost about 320,000 residential video subscribers in the quarter.
Yeah, and that was versus the 230,000 that analysts had projected. So a big miss, and it looks like that overwhelmed the earnings beat that we saw here from the company. And really, investors and analysts are looking for more information going forward on what broadband trends are going to look like. That's according to Stephen Cahall over at Wells Fargo. He says broadband trends and mobile roll to pay will be the keys for sentiment going forward. And he said Comcast results likely spooked that broadband competition is still destabilizing. So a lot of concern around broadband in particular.
It's interesting as these cable providers listen, we know about the headwinds and the challenges they're facing. I thought it was interesting. Bloomberg noting that customers, obviously, they're moving to these wireless home internet services like the kind offered by T-Mobile, by Verizon, which Bloomberg notes registered 941,000 fresh customers in Q3.
Yeah, so still a lot of competition there. And another stock we're watching is AMC, looking for another big weekend with Taylor Swift's Eras Tour concert film, the record-breaking concert movie, heading into its third weekend at the box office after already bringing in $179 million thus far. And also, a new title for Taylor Swift.
What is it?
Billionaire.
Mazel tov.
That's what the reporting is that because of, in part, ticket sales from the concerts, et cetera, that she is now a billionaire. But if you look at the AMC shares, and of course we've been watching them, they have been somewhat tied to what's been going on, of course, with Taylor Swift and the demand for the movie. But they didn't do a heck of a lot in today's session.
No. I am reading reports, that Taylor Swift's concert film opened mid-October, October 12th. It's now already raked in more than $178 million. And of course, AMC CEO Adam Aron on X reminding us that's playing at all AMC theaters in the U.S. and Europe, in case you're wondering.
Oh, thanks. Thanks for reminding us. One thing I will mention, AMC has done some interesting financial engineering, as we know, with its APE shares, et cetera. Do you recall that it also owns a stake in a very small mining company?
I do remember that headline.
Yes.
Yeah.
The company is called Hycroft. It trades separately. AMC owns about 12% of that company. And yesterday, Hycroft announced a reverse share split, a 1-for-10 reverse share split. Why is it doing a reverse share split?
Yes, that's the question.
You don't really want this to be happening if you're a shareholder. It's because they're in danger of being delisted because the shares are
That's a good reason.
not worth very, they're not priced very highly at this point. So is that affecting AMC? Unclear. It certainly affected those Hycroft shares.
Do we know if Adam Aron tweeted about that one? Or
I did not see that.
Well, we'll check.
Yes.
All right, moving on. Oil pushing higher today on fears of escalation in the conflict in the Middle East. Crude trading, let's see, WTI up about 2.4%, Brent up about 2.5% there. And with higher oil prices, oil producers have been getting a boost. But on the flip side, we've seen solar stocks, they are plunging as of late, mainly on weakening demand for products despite talk of an energy transition toward renewables. Today, solars are being dragged by Q3 results from solar battery company and Enphase. Enphase missing on revenue estimates for the quarter and warning its sales slowdown could go into early next year. For more on where we stand in the energy transition, we turn to Pavel Molchanov, Managing Director and Equity Research Analyst at Raymond James, and Neil Dingman, Truist Managing Director. Neil, I actually want to start with you here because I'm curious, Neil, why I have you. Exxon and Chevron, those results, they both missed quarterly EPS estimates. What did you make of those reports, Neil, and what are your ratings on those two?
I'm a buy on Exxon and a hold on Chevron, and I thought both were a bit sloppy for the quarter. I was more concerned with Chevron's. Their 45 billion Tengiz project had a bit of delay and cost overrun, and it goes back to sort of my thesis. Even with the new deals that both of them announced recently, I think Exxon's assets are more quality assets. I think that's going to continue to show up. And, I think today was another example of just a little bit uncertainty around, the cost of one of Chevron's key assets.
And Pavel, I want to bring you in on the other side of the coin, the renewable energy side of the coin. Enphase Energy kind of exemplifying that with its tumble today following earnings. And I guess big picture, what I'm sort of struggling with here is, okay, big oil had a not great quarter, but still, right, making tidy profits here. Renewables, despite the support from the U.S. government, don't seem to be doing too great. Where are we in this whole energy transition as exemplified by some of these earnings reports?
Energy transition is it's a mega trend measured in decades, and admittedly from quarter to quarter, it's not always going to be as apparent. Look, the solar market, as is true of every infrastructure intensive industry, requires large amounts of external capital. There's no escaping that. When interest rates go up, companies that, for example, build solar power plants need to raise money at higher cost, higher financing costs. And that, all else being equal, slows down the pace of installations. Now, 2023, still a record year for solar installations overall. That includes the United States and globally, but it is certainly not as as aggressive a build out as perhaps we would have expected at the beginning of the year when the 10-year Treasury was a lot closer to 4% than 5%.
And I wanted to switch gears. I want to ask you about this report from the IEA, the International Energy Agency. It made some headlines this week. I don't know if you saw this one. They're saying global demand for fossil fuels likely peaks before the end of the decade. Coal, oil, natural gas. So that's their forecast. I'm interested when big oil gives a forecast. When Exxon is looking ahead, long-term demand for oil and gas. What do they see, Neil?
They see. I mean, again, the EIA seems like about every, other year they seem to extend when that peak demand is going to happen. I've seen that now. I mean, I've done this, 20 odd years, and it seems like I've seen it every other year. So the big oil, I think, basically will come out and say they think it's at least another 10, if not 15 years beyond that. And, I think we've seen this in Europe. I think we've seen it just throughout the world. There might be some calls of that in the near term, but we're just not seeing any signs of that yet.
And Neil, to follow up on that then, so what does the next year to 2 years look like for big oil?
I think it's going to be a bit more the same, and that is these companies now are turning into or have turned into just these huge shareholder return vehicles. And you've seen now Exxon and Chevron, even today, paying back billions of dollars each quarter to investors. So I think that's going to be the key is the capital discipline is going to stay on one side, and the other, what that's going to translate by keeping that production flat and keeping their spending relatively flat. They're going to continue to have a ton of money to pay back to investors in the form of both dividends and buybacks, and I don't think that's going to change.
So, Pavel, we heard what Neil had to say about buy on Exxon, hold on Chevron, excuse me. When you switch it on over to the renewable space again, and the selling that we have seen for much of the year in that group, are there opportunities now that you're seeing?
All the stocks are on sale. That is absolutely true. So both on the interest rate freakout, just the macro multiple compression, that is the number one reason why the stocks are down. Some fundamental effect on the business, although that's more secondary. So you mentioned Enphase, ENPH. This is an S&P 500. One of only 3 solar companies in the S&P 500, by the way. So this stock a year and a half ago was trading at 45 times forward earnings. Today it's trading at 20 times forward earnings. Now, estimates have come down. That is also true. But the bulk of why the stock's down is the compression in the multiple. So from 45, valuation cut in half to 20, that is not price for perfection by any stretch of the imagination. I would look at that one. On the small cap side, I would mention Ameresco, AMRC. This is a company that is involved in all kinds of facets of energy transition. It's involved in efficiency, it's involved in solar, and it's involved in renewable natural gas. The latter two portions of the business depend on external capital, which is why this interest rate freakout, as you can see, has really decimated the stock over the past, 100 days.
So I guess the question is, Pavel, and this is a question that really is across sectors. It's not just renewables, right? We've been hearing from some strategists, we can't start to see really meaningful recovery in certain sectors or even the market overall until we get some stability in rates. Is that true, do you think, of this sector as well?
Yes. I mean, certainly the monetary backdrop and the kind of broader sentiment around cost of capital is one of the variables. I think it's an important one. Keep in mind, however, that's not the only thing that counts. So you touched earlier about the fact that oil and gas companies are making money hand over fist from high oil prices. Well, high oil prices and to some degree natural gas prices are also feeding into electricity rates that are relentlessly going up. This is an important difference, between the oil market and the power market. In the power market, prices never go down. They only go up in one direction. So when electricity prices go up, guess what? That makes the economics of solar and wind and bioenergy and efficiency and green hydrogen more economic than it would have been otherwise. So that is a tailwind that we should not lose sight of, regardless of what happens with interest rates.
Guys, really appreciate you laying out the two sides of the energy coin right now, and hope to have you back again to continue the conversation. It's not going away. Pavel Molchanov and Neil Dingman, thank you both. Really appreciate it. Have a good weekend. And of course, as we talk about the transition to clean energy, one theme for automakers this earnings season is weakness in electric vehicles. Yahoo Finance senior autos reporter Pras Subramanian here with the details. And, it's quite interesting that we have not been hearing a lot of super optimistic commentary about EV demand.
Yeah, it's funny. Just only a few months ago, we saw, or even this in Q3, we saw EV sales hitting a tipping point here, nearing 8%, according to KBB, a record 300,000 EVs sold in Q3. But now, cut to a few weeks later, Ford, GM, even Tesla, all warning about how the EV market is sort of slowing down, each with its own sort of concerns. With Ford, they're pushing back around $12 billion in EV investments, saying that buyers are unwilling to pay a premium for EVs over gas-powered cars. GM sort of echoing similar complaints or concerns, talking about slower near-term demand for growth, having them pause investments. And like I said, even Elon Musk saying that, higher rates here, higher finance costs. He says we need to make the cars cheaper in order for people to buy them. And maybe perhaps right now they're not. So, what's sort of happening is that early adopters and people like that have already spoken for, and high prices are kind of keeping middle-class buyers, a lion's share of buyers, away from EVs at this point. Some would say even politics are getting in the way. But I think bottom line, though, Julie, I don't think the EV transformation is going away. It's just going to take longer than what people thought in this current environment. The cars are better for the environment, better CO2 emissions, obviously none, easier to maintain, offer better performance. But we're just not seeing that full transformation just yet. It's just going to take more time to get there.
Pras, thank you so much for that. Have a great weekend.
Thank you.
And coming up, Ozempic frenzy. We're going to break down the real demand picture for weight loss drugs after the break.
"2023 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation, mortgage rates,
The diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it November 7th, exclusively on Yahoo Finance.
Weight loss and diabetes drugs have captured Wall Street's imagination of late. Goldman Sachs projects these drugs could serve 15 million people by 2030. But what does the demand picture actually look like for all of the hype out there? We have been talking about this a lot. And Yahoo Finance's Anjali Kamlani and Brooke Palma have been digging into it. Anjali, let's start with you. So where do we stand right now with usage of these drugs?
Well, let's start off actually with just what they do, right? We know that they are weight loss and diabetes drugs. Majority of the drugs out there, of the three, Novo Nordisk's Ozempic and Eli Lilly's Mounjaro, are actually diabetes drugs. And only Novo Nordisk's Wegovy is actually approved for weight loss. But what does that all mean? Of these new formulas of GLP-1s, that's what they're called, they actually have just been really spectacular at providing record weight loss. And that's why they're so popular. As you can see on your screen, Ozempic really taking the lead there with $3.1 billion alone for the last quarter. Meanwhile, Wegovy over $1 billion, and Mounjaro just getting to that billion mark, making them already blockbuster drugs. And this is just for use in about 1% of the population. Novo Nordisk's data does show that a majority of the users are still diabetes users. So even though we're hearing so much about what the potential is for weight loss, it is still being used by a largely diabetes population, in large part because of the restrictions on insurance, the fact that there's production issues, so there's a shortage. So all of these are creating barriers essentially for broader uptake. And so that's sort of where things stand right now, is not the frenzy that you're necessarily hearing, but more of a slow ramp up, if you will.
And Brooke, turning to you, we can see how this could mean big profits for drug makers, but how does this also impact other companies like restaurant chains?
Yeah, Josh. Well, the drug doesn't necessarily stop you from eating entirely. It just really curbs your appetite. It makes you feel fuller for longer, and that can impact foot traffic at companies, or rather chains, that typically do cater to customers looking for a quick snack or beverage. Jack in the Box and Taco Bell, owned by Yum Brands, are often visited by snackers in the early afternoon or late night after 9 p.m. We could see a drop in traffic then. Coffee giants like Starbucks and Dutch Bros typically cater to visits that are not necessarily tied to consuming a meal. Half of visits are not tied to consuming a meal there, so they too could feel the impact. And what exactly people choose to eat could change as well. That would impact more fast casual chains like Olive Garden, Texas Roadhouse, or Chili's. Consumers could order less appetizers or desserts. And once again, those are consumers that are taking the drugs. And Stifel analyst Chris O'Call said in a note that if 25% of customers are using weight loss drugs and all of them choose not to get an appetizer, that could lower sales by roughly 1 to 2%. But Anjali, 25% of customers doesn't seem too realistic in the near future, does it?
That's right. Going back to that 1% that are currently on. And we're talking about, to the Goldman Sachs note earlier that Julie mentioned, 15 million is nothing compared to the 100 million people that are, allegedly impacted by obesity right now. So that's a huge market that could potentially be impacted. And just a small portion is what we're talking about, especially by 2030. Important to point out what you said earlier as well, which is, this drug doesn't necessarily curb your appetite, though there are some studies about curbing addictions. It just makes you feel fuller for longer because it slows down the appetite. And that's the only thing that this drug does. And it helps to stimulate insulin production. So key to remember what this actually does versus what it's being used for. But I think that's all in context, Brooke. We talk about what this potential impact could be to especially the food and beverage industry. It feels like they've already sort of been working on stuff related to maybe healthier eating, right?
Yeah, Anjali, some of the stocks that we've seen get hit the hardest in the last month, 1 to 2 months, is really food and beverage giants like PepsiCo and Coca-Cola, as well as snacking giant Hershey's. All of them saying that they've been evolving their portfolio strategy to already meet a healthier consumer lifestyle. Hershey's back in 2021 introduced a 0-calorie and protein bar options. PepsiCo flagged portion control and the popularity for mini canned sodas among consumers in July of 2020. And most recently, we've heard from Coca-Cola on its earnings call that it feels like it's well positioned to provide consumers with choice. And so really at the end of the day here, it's really important to note that the larger implications of these weight loss drugs are still widely unknown.
Anjali and Brooke, thank you both. And turning out to GDP numbers out this week, red hot, with the latest read showing the U.S. economy expanded by 4.9% over the summer. That is the fastest pace in 2 years. But is it enough to convince voters that Bidenomics is working and turn the tide in the polls? Yahoo's own Rick Newman may have the answer. Rick.
Hey, guys. I think the answer is no. This has become a depressingly familiar pattern for the White House. We get terrific economic news, and Biden's approval rating doesn't budge at all. In fact, if you compare the great news about GDP this week, which we did know was coming, by the way, to what we saw in consumer confidence, the latest from the University of Michigan, people are more bummed out than they were last month, the month before that, or the month before that. We've seen consumer confidence going down 3 months in a row. Biden keeps trying to talk up the good things that are happening in the economy, and it's just not working. It's a bit perplexing because we have a super low unemployment rate of 3.8%. We know the main thing that's bumming people out, it's obviously inflation. But inflation is down from a peak of 9% last year to only around 3.7% now, and yet Biden is just getting no love from voters. So if you're in the Biden White House, you really must be pulling your hair out, or whatever hair you have left.
And there might be another headache for Biden, although this is probably a more minor one. A guy named Dean Phillips, who it looks like is going to be challenging Biden in the presidential race.
I did not know who Dean Phillips was. I'm going to guess you guys probably didn't either. He's a member of Congress from Minnesota. He is a Democrat, and he says he's a fan of Joe Biden and Joe Biden's policies, and he agrees with most of what Joe Biden is doing. He says it's just time for younger leadership in the country, and I believe he's in his low 50s, so he thinks he's the right age. He is not going to win. He is not going to beat Joe Biden in the primaries. He probably won't even make much of a dent. But it is a little bit unusual that an incumbent president is getting a challenge from somebody right in the middle of his party, not from a fringe candidate like a Bernie Sanders or somebody like that, but from somebody who says he agrees with the president on almost anything. He just thinks the president is too old. So, nobody knows exactly what's going on in Joe Biden's head. He must consider himself a spring chicken, or he thinks his experience is important and valuable, especially at times like this when we're facing this war between Israel and Hamas in the Middle East and possible escalation. He is an established and experienced statesman, but this guy Dean Phillips is channeling the thinking of a lot of voters, which is, we like Joe Biden, but it's just time to step aside. But he's not going to step aside, so here we are.
According to Wikipedia, Dean Phillips is 54 years old. So there you go. Indeed,
a youngster, a youngin'.
Considerably younger than the president. Exactly. Rick, thanks so much. Appreciate it.
Bye, guys. Happy
Coming
weekend.
up, J.P. Morgan. Thanks, you too. Thanks, Rick. Coming up next, J.P. Morgan Chase CEO Jamie Dimon raising eyebrows with the announcement he's selling shares for the first time ever. While he says he's staying put, we'll take a closer look at what's happening in the C-suite at some of America's largest companies, including the banks. That's next. JP Morgan Chase CEO Jamie Dimon plans to sell 1 million shares of company stock. That's his first such sale since taking over as CEO. The move sparking some concerns that Dimon could be contemplating retirement. And while that might not be the case for Dimon, there are a record number of CEOs heading for the door this year, putting succession plans and C-suite shakeups front of mind for investors. Joining us now is Bill Cohen, Puck News founding partner and longtime watcher, particularly of Wall Street CEOs and their moves around. Bill, it's good to see you. Thanks for being here. I want to start actually with a succession that seems to have worked out, at least in terms of it actually happening, and that's Ted Pick over at Morgan Stanley, who's just been appointed to take over from James Gorman after maybe some impatience being expressed on the part of investors that it wasn't getting done already. Do you think that that's sort of a model for what some of the other banks should be looking to, or indeed corporate America broadly?
Well, first, Julie, thank you for having me. Always great to be here, especially with you. Look, you got to give James Gorman at Morgan Stanley credit. He actually did it. He left pretty much on top, and he chose a successor, and he got the two guys who were not chosen to stick around. We don't know for how long, and we don't know if that's going to necessarily work for Ted Pick, his successor. But unlike Brian Moynihan or Jamie Dimon, Brian Moynihan at Bank of America, Jamie Dimon, as you mentioned, at JP Morgan Chase, who really have not done a whole lot on the succession front, at least that they're talking about, and they've been around each for about nearly 20 years or so at the helm of their banks. James Gorman got it done, and he exited the stage. Yes, he's going to be executive chairman of the board, which means that he's still sticking around and is effectively Ted Pick's boss, as he has been, but it'll be Ted Pick's show to run on a day-to-day basis for the foreseeable future. So kudos to James Gorman for getting it done.
Did you think, though, Bill, some people were kind of, eyebrows were raised on this one. Just want to get your take on this, because they thought, well, Gorman, though, has been focused on, growing wealth management, and in comes Ted Pick, obviously, head of banking and trading. They thought they were interested in that sort of turn there. Did that get your curiosity up at all, or no, you thought that made sense?
Well, I think I wrote a piece in Puck last May predicting that Ted Pick would be the winner, and here we are in almost November, and he is the winner. So obviously, I was not surprised Ted was chosen. I've never met Ted, which I find sort of interesting. Maybe that'll change now. But look, the pendulum swings. James Gorman came from the brokerage, wealth management, asset management side of Merrill, and then at Morgan Stanley, engineered the acquisitions of Smith Barney, E-Trade, Eaton Vance. I think it was, Ted Pick has done a pretty darn good job resurrecting Morgan Stanley's investment banking business and trading business since the near calamity of the 2008 financial crisis. So I wasn't surprised that he got the job, because I think the pendulum does swing back and forth. It was James Gorman was a asset management, wealth management guy, and so now time for Ted Pick, the investment banker, to take control. And I think Ted is sort of a central casting kind of CEO guy, probably more than the other two. And to me, this was a clear choice. And again, at least to Morgan Stanley's credit, they set up a succession. It was clear it was going to happen this year. It was clear it was going to be one of three guys, really one of two guys. And that's more than you can say about either JP Morgan Chase or Bank of America.
Well, and I want to ask about those two, right? Because you mentioned the financial crisis, and those two have CEOs that have been hanging around since then. And I think most investors have been relatively pleased with their performance. But at some point, they got to go, right? It can't last forever. So what do you see as the path there?
Well, Julie, as we both know, no one gets out alive. And the path is he's going to have to choose a successor at Jamie Dimon and Brian Moynihan. Everybody has to choose a successor. It's the most important thing a CEO does, and hopefully they get it right. I just wrote a book about GE where Jack Welch, unfortunately was keen to tell me that he made a mistake in his succession choice. Jamie still and Brian still have a big opportunity here to get it right. It's not the easiest thing in the world. A lot of people have left both companies waiting to see whether they would be in line to succeed these long-serving CEOs. And so they've lost a lot of talented people who got tired of waiting, especially so at JP Morgan Chase, where there's a lot of people now CEOs of other banks and financial institutions that got tired of waiting for Jamie to give up the role. I understand completely why he doesn't do it. It's the greatest job in the world. He's doing a fabulous job. The board keeps rewarding him. He's got this special award that he received in 2021 that he gets in 2026 if he sticks around. So I don't think he's leaving until then, at the very least. This stock sale is something probably, his first one ever, and he certainly deserves to do that. So that's not an indication of anything. They need to be. If I were both of those CEOs, I would be much more explicit than they have been, like James Gorman was, about the succession timing and candidates to be in that race.
Bill, if we're talking succession, I can't let you get out of here without getting your thoughts on Mr. Bob Iger. How would you grade his return so far, Bill? Or do you think it's too soon to give him the grade? And oh, by the way, do you think he's really only back for a couple years?
Well, it's been a year, right? I don't think Iger 2 has gone nearly as well as the reign of Iger 1, which was like 15 years. He got an extension for another couple of years, whatever it is, 2025 or more. I don't think it's gone particularly well at all. The stock is at or near all-time lows. He's got a whole lot of problems. I don't think he even realized how big the problems were when he came back a year ago, although you'd think he should have known that because he certainly was hanging around the hoop during the time that Bob Chapek was the CEO. So I don't think it's going particularly well. I think he can still rectify the situation, but he hasn't really done a whole lot strategically that's gotten investors excited. And now he's got the return of Nelson Peltz for a second go round. So we got Iger 2 versus Peltz 2. Quite the sequel.
Yes, indeed, quite the sequel, and one that is interesting for all of us to watch. Zoom way out here. We've got over 1,400 chief executives that have left their positions during the first 9 months of the year. That's according to Challenger Gray and Christmas, which is a big increase. What do you think is going on here? Is it just that CEOs are humans and they're stressed out just like the rest of us post-pandemic? Is there something else sort of going on in corporate America? What do you think?
Yeah, look, these are hard jobs. There's demand. If you're a public company CEO, the demands on a quarterly basis are obviously quite rigid and unrelenting. Shareholders are obviously always want the stock to go up, but it doesn't always happen. In the last few years, kind of the stock market has gone sideways. Despite good economic news, the bond market has obviously had a rough go of it, as was easily predictable. But the fact that interest rates are now in the 5% range for short-term interest rates means that there's a real alternative to the stock market at the moment. That's probably why stocks have been going sideways despite relatively strong earnings. So they're not getting the rewards that they used to get. It's probably not as much fun as it used to be. You're right. People are human. CEOs are human like everybody else, and they're probably stressed out. And wouldn't surprise me that people want to go. And there's always somebody behind them who wants that job. So it's not like those jobs go vacant for very long.
Bill Cohen, thank you so much for joining us today, for your time and your insight, Bill. Appreciate it.
Thank you for having me.
And coming up, many companies and colleges taking a stand, voicing opinions about the ongoing conflict in the Middle East. We're going to break it all down with the Anti-Defamation League's Chief Impact Officer. That's next. More than 100 companies, including the likes of Google, Adidas, and UPS, have signed a pledge to fight anti-Semitism in their workplaces as the war in the Middle East intensifies. The Anti-Defamation League, known as ADL, has pooled resources and educational material for companies to follow, as well as creating an urgent appeal to call out violence and hate. Organization's Chief Impact Officer and Senior Vice President Adam Neufeld joins us now. Adam, thank you so much for joining us.
Thank you so much for having me.
And Adam, so you're asking businesses to sign on to this workplace pledge to fight anti-Semitism. What exactly does this pledge ask these companies to do, Adam, and what's the response been like so far?
It requires companies to take 4 common sense steps, and some of them have already taken it, some will take it over the next year. First, it means they need to teach about anti-Semitism as part of their DEI program. We found in our surveys that most companies now have DEI programs, but anti-Semitism in the Jewish experience is lost in there. Second, it asks people to support Jewish employees in the way that they support other minority groups. Sometimes that's in employee resource groups, sometimes that's an affinity group, sometimes that's just programming. Third is we find that even still in 2023, companies still are not consistently doing well when it comes to religious observances for Jews, for Muslims, and many other groups. So we want them to reassess. And then finally, we want them to use their bully pulpit. Most companies nowadays speak out on lots of issues. Anti-Semitism can't be exempt. We found that this was already moving quickly, and after the horrible massacre of just a few weeks ago, we've seen companies really step up. We're now at over 100 companies, as you mentioned, and it's growing by the day.
Adam, it's very interesting to me that part of this pledge, 3 of the 4 are internal elements, right? That they are more about supporting employees in DEI initiatives. The last item, though, probably gets more attention than all of the others, I feel like, as of late, as there is enormous pressure on companies and all kinds of institutions to make these types of statements. Do you think that, like, where do companies need to speak out on everything now? What is the role of the corporation in American or global public life that they have to make a statement on not just this important issue, but on almost every political issue? Where's the line, if there is any?
It's a great question. Our view as ADL is you don't have to speak out as a company. Every company has a different use of their voice, and that's okay. But our view is if you are speaking out on hundreds of issues, from climate change to anti-Black racism, anti-Semitism can't be exempt. And so that's our real message here. If you're silent on all those issues, we understand companies who do that. That's okay. But if you're going to speak out, make sure anti-Semitism and Jews are part of that.
And Adam, I want to switch gears here and talk about another issue, which is what we see going on college campuses. Adam, you know this. You're watching institutions like Harvard, like Penn. They are dealing with backlash. They're dealing with donor revolt. You have alumni upset about how these institutions responded and reacted to the Hamas attacks. They're upset about the environment that the Jewish students at these institutions find themselves in. I'm just curious, Adam, how you and the ADL are thinking about that issue.
Sure. We've been working on anti-Semitism on campus for decades. And have become increasingly concerned. But I have to just admit that after October 7th and the response on campuses were even more disappointing for people who follow it. The immediate celebration by certain groups, again, a small minority, but a really vocal minority, combined with administrators often not losing their voice and not speaking up. We are definitely seeing university presidents speak up, but still too many are not. And I think it's a really important contrast to what we're seeing from CEOs. Again, not every CEO is doing everything we want, but we're seeing, per earlier comments, a lot better. But we're very concerned and working with many concerned alumni to try to get universities to address the small but incredibly vocal minority in their midst that is celebrating an unbelievable amount of terrorism.
Now, Adam, just as I asked the question before about where the line lies for corporate America, there's an important question about where the line lies on college campuses, not just with this issue, but in recent years, we've seen a lot of discussion of certain groups not being welcome on campus to speak on certain issues. So how does this then play into free speech and how you keep students safe on campus while at the same time allowing dissenting opinions.
I should be clear, we have no problem with vociferous debate around Israel, around Middle East, or any other issue, right? That is what college is about, as you're suggesting, and what society needs. We're firm believers in freedom of speech. But what we've seen is something far worse than that. We've seen groups that are celebrating terrorism, and the rest of society or the rest of the school is often shrugging or being silent about that, right? In that, we would not tolerate that if that was a neo-Nazi group on campus, and we shouldn't tolerate that if it is a group that wants the destruction of Israel. So we think that if a university can take lots of steps and still let students and faculty and others have difficult conversations, that they should be having in campus.
And Adam, just a final question here about the demographics that I think is interesting. I would love to get your take on this. When you look at polling on this issue, Harvard-Harris poll, for example, shows Americans still overwhelmingly support Israel, more than 80%. But the demographic breakdown there is interesting because it's really stark, Adam. So broken down by age, 95% of seniors said they side with Israel, according to Harvard-Harris. But when you look at the 18 to 24 demographic, it drops sharply to 52%. I'm interested to understand, get your viewpoint on what do you think that is? What do you think explains that?
It's a trend that we've been watching and are unbelievably concerned about. We think part of it is depending on when you grew up and learned about foreign policy, Israel means different things to you. It's also, I think, a sense that for a very misguided view of Israel is through the colonial world, right? That this is some colonial power, and you hear things like that, and you see it in the signs, as opposed to the scrappy startup that was created right after the Holocaust that many older people did. And so we're worried about that, which is why I think you're seeing some of what's happening on campus.
ADL Chief Impact Officer and Senior Vice President Adam Neufeld. Thank you so much, Adam.
Thank you so much for having me.
And coming up, it's closing time here on Yahoo Finance. We recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
It's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Sam Bankman-Fried facing a setback in his defense. Judge Kaplan ruling that most of SBF's proposed testimony that FTX lawyers were involved in making decisions couldn't be said in front of a jury. The defense team had hoped to argue the involvement of FTX's attorneys showed that Bankman-Fried was acting in good faith in circumstances that prosecutors have alleged were crimes. In his testimony, Bankman-Fried said that despite being CEO of FTX, he wasn't always in the know when it came to how his company functioned. The hearing has finished for the day, and next week, SBF will face cross-examination. X unveiling 2 new subscriptions. One plan, $16 per month, that lets subscribers pay more to get the biggest boost for their replies. It's called Premium Plus. The other is a new basic option for $3 per month. However, that plan doesn't let you pay your way to verification. Remember, X just passing a year under Elon Musk's ownership. And General Motors reportedly on the verge of striking a deal with the United Auto Workers Union. Reports say GM matched Ford's 25% pay raise to end its 6-week strike.
Time now for what to watch next week. Investors can expect the next Federal Reserve decision on interest rates. Fed Chair Jay Powell has signaled the central bank could hold rates steady, but warns of more hikes if the economy stays surprisingly hot. The FOMC meeting comes ahead of the next jobs report later in the week. Latest labor market data to be released for the month of October. This would precede the September job numbers that blew past estimates as wage growth slowed from the prior year. Meanwhile, a new reading for consumer confidence is out Tuesday morning. The data for the month of October coming after confidence fell again in September. As for earnings, Apple set to report its fourth quarter results on Thursday. Investors to eye the tech giant's iPhone sales and commentary surrounding China's crackdown on Foxconn, one of Apple's biggest suppliers.
Well, that'll do it for today's Yahoo Finance Live. And, we wrapped up the week of spooky stocks. Now,
I'm gonna miss that.
It's Halloween weekend, you guys. Have a great weekend. Josh and I will be back here at 3 p.m. on Monday.